Back in September, I think it was, stock was around $205. You had a $170 price target. You said the reality was margins were going to be hit by tariffs. Weak iPhone cycle. You expected to be historically weak. I have in my notes, and I hope I said, but look at Disney and Roku. Couldn't the stock move on services valuation-wise? Couldn't the phone launch be stronger based on trade-in incentives? And it was. So why are you still so low on the stock? Have you done enough looking through where you were wrong to be confident that you're right now?
Well, I hope so. So, John, the crux of what we discussed back in September was the iPhone cycle is going to be a weak cycle because the iPhone 11 is not bringing to the table enough innovation. That's clearly what we got wrong, what I got wrong. And that's, yesterday was a confirmation of that. The iPhone 11 was actually a very strong cycle. It dragged consumers in. People want to replace their phone. People want to have this iPhone. For what reasons? It's always very difficult to capture, but I think you have three things. The first one is the iPhone 11 looks different. Like the camera in the back, it made really the headlines in terms of look and feel. Some of the features were really well received. The camera itself, and of course the battery life. And then the last thing is that Apple did something absolutely fantastic. They took the prices down compared to the previous cycle. And I think it dragged all these people who did not move to the 10 and then moved to the 11 thinking they were making actually a very good deal. And that's clearly what we missed the most.
But there was also, I would argue, something you missed on valuation. I think the stock started moving even before it was clear that the 11 was going to be such a strong cycle. Apple's valuation has just expanded. Maybe that was because of services. Maybe it was because of wearables. How do you factor that in?
Yeah.
I think you have it at 18.5 times is what you're assuming it'll be going forward?
Yes, exactly. 18.5 times 21 earnings. So, John, if you look back over the last 5 years, Apple has always traded on a fairly wide valuation range. When the iPhone is doing great, you're at the high end of the range. When it's not doing great, you're at the low end of the range. In September, I was calling the iPhone being at the lower end of the range. I had a much lower multiple. This time around, I'm thinking 18.5 times earnings means Apple is in line with the broader market, with the S&P 500. And that's actually the higher end historically of their trading cycle. So I think that's a place where I'm comfortable with valuation. Going forward, if I were expecting continued monster, beats on expectations, increase in positive sentiment, I could venture into a higher multiple than that. But today, I think most of the good stuff has happened.
Wamsi, one thing's for sure, Pierre's not alone. Survey work has failed a lot of analysts, both on the demand and the supply side. So what is the best tell, the best metric if you're going to try to build a model on at least iPhone?
Yeah, it's a tricky situation because when you look at sort of where iPhone demand was a year ago, I think most people thought that iPhone was potentially going to decline from there forward. But what has really happened is that you're coming back to a normalization to about 210 million units or so. And that's what we think will continue over the next several years, given the visibility that you have around both replacement cycles potentially coming in with 5G a little bit, but also the fact that you went through a real trough in China demand, which is now renormalizing. So we're at a point where we can anticipate about 200-ish million units, and that's great for the multiple because it adds predictability. The reason the multiple really suffered before was because people were worried that the iPhone was heading towards a cliff decline and margins were going down. In fact, what we saw from the print was that not only iPhones were strong, but we also saw the fact that gross margins are actually being guided up, the high end of the range, as much as 39% when people were worried that gross margins could be headed down towards 36%. So I think that's the big differential that accounts for this change in valuation structure. When people look at the stock, even though services came in a little light, it's less of a concern when you think about what is happening on the base iPhone business.
So do we need to now worry about pricing? If we're comfortable with units, do ASPs matter more this year than last? You.
Thanks. No, I think pricing is on a very safe trajectory. Of course, we expect like an additional iPhone to come through in the near future, in the coming weeks or months. It's going to be a lower ASP phone, but given where we are already with the existing portfolio, it's going to be on the upside. So I wouldn't worry about pricing. Then when we come into the 5G cycle, there is going to be an interesting debate around how does Apple reflect the cost of 5G into its price, but that's probably something we should discuss next time.